Okay, let's pull back the curtain on something that often feels, well, a bit complex, maybe even intimidating. Options trading. You, our listener, sent us a great beginner's guide, and we thought, let's do a deep dive. Let's unpack this together.
Yeah, it's a good starting point. And our goal today is pretty clear. Break down the core ideas, the upsides, the downsides, and, how to maybe start learning responsibly using this guide as a map.
Right, getting that solid foundation without getting totally overwhelmed.
Exactly. Because let's be honest, for many people, the word options just sounds like complicated finance stuff, right?
Definitely. Maybe images of frantic trading floors or complex charts, it can feel out of reach.
So we want to make it clearer, more relatable. We'll use the examples from the source to show you what it actually involves.
And the source starts off really well, I think, with some everyday analogies.
It really does. It frames an option as basically paying a small fee for the right to do something later. But the key part is it's not an obligation.
Like putting a deposit on a house.
Exactly like that. You get the right to buy, but if things change, you can walk away. You just lose the deposit. Or like buying insurance. You pay a premium for that right to claim if something bad happens.
The source even mentions supermarket coupons or pre-ordering a fancy bag, paying a bit now for a future choice.
Yeah, all great examples. That phrase, a right, not an obligation. That's the absolute heart of it.
Okay. And in finance speak, these are financial derivatives. Sounds fancy.
It does sound a bit complex, but it just means their value derives from something else, the underlying asset.
What kind of underlying asset?
Oh, it could be a stock, like Apple or Tencent, or a whole stock market index, commodities, currencies, lots of things.
Got it. So it's different from just owning the stock itself. An option on Apple stock gets its value from Apple stock moving around.
Precisely. Its value is derived. And that choice element you mentioned, the right, not the obligation, that's what gives them so much flexibility.
Okay, so what actually makes up one of these option contracts? What are the ingredients? The source laid them out.
Right, the building blocks. First, you've got the underlying asset. That's pretty straightforward. It's the specific thing the option is about.
Like the 10-cent stock example in the source, 0700HK?
Exactly. Or it could be the S&P 500 index or oil futures, whatever the option is tied to.
Okay, what's next?
Then the option type. Basically two flavors here, call options and put options.
Call and put.
A call gives the buyer the right to buy the underlying asset at a specific price. You'd usually buy a call if you think the price is going up.
Makes sense. And a put.
A put gives the buyer the right to sell the underlying asset at a specific price. So you typically buy a put if you expect the price to go down. That's the fundamental choice based on your view.
Right. Call for up, put for down, if you're the buyer. Then there's the price involved.
Yes, the strike price, sometimes called the exercise price. This is the fixed agreed-upon price the buyer can buy at for a call or sell at for a put if they decide to exercise their right.
And how does that relate to the current market price?
Ah, that's key. Whether the strike price is above, below, or right at the current market price determines if the option is in the money, at the money, or out of the money. That heavily impacts its value. Exchanges offer a whole range of strike prices to choose from.
Okay, the what price? And these things don't last forever, right? There's a deadline.
Absolutely crucial. The expiration date. Every option has a limited shelf life. It's the very last day the contract is valid.
And if you do nothing,
Poof. It usually expires worthless. Options can expire in days, weeks, months, even years for those long-term ones, elite APS.
so time is definitely ticking. What's the cost to get this right?
That's the premium. It's the price the buyer pays to the seller for the option contract itself for that right and for the seller taking on the potential obligation.
How is it quoted?
It's usually quoted per share of the underlying. But you pay for the whole contract, so if the premium is, say, $2 per share and the contract covers 100 shares.
You pay $200.
Exactly. And what influences that premium? Things like how far the strike price is from the current price, how much time is left, and how volatile the market expects the asset to be.
Okay. And for the buyer, that premium is their max risk.
Yes. For the buyer, the most they can lose on that specific trade is the premium they paid. For the seller, the premium they receive is the most they can gain.
Got it. Last piece.
The contract size. This tells you how much of the underlying asset one contract represents. For stock options, the standard is almost always 100 shares per contract. So that $2 premium means a $200 total cost for control over 100 shares.
Okay, so asset type, call put, strike price, expiration date, premium, and contract size. That defines the deal. Now, you mentioned a buyer and a seller. Let's talk roles. Who gets what? Who has to do what?
Right. The source has a nice table comparing them. The buyer pays that premium up front. They get the right, remember, but crucially, no obligation.
So they can just walk away if it's not looking good.
Exactly. Let it expire worthless, their risk. Strictly
Right.
limited, they can only lose the premium they paid.
But the potential upside.
Potentially very large. For a call buyer, it's theoretically unlimited if the stock price skyrockets. For a put buyer, it's substantial if the price falls towards zero.
Okay, buyer pays, gets right, limited risk, big potential gain. What about the poor seller on the other side?
Well, they get the premium up front, which is nice immediate income,
Right.
but in exchange, they accept the obligation. If the buyer exercises, the seller must fulfill the contract, sell the stock if they sold a call, or buy the stock if they sold a put.
So their profit is capped?
Yes, their maximum gain is just the premium they received.
Yeah.
But their risk, that can be significant,
How significant?
potentially huge, even theoretically unlimited, especially if they sell naked call, meaning they sell the call option without actually owning the underlying stock to deliver if needed.
There's that asymmetry again. Buyer pays a bit for freedom and potential. Seller gets paid a bit, but takes on this potentially massive obligation.
Exactly. The premium is meant to compensate the seller for taking that risk. Before trading costs, it really is a kind of zero-sum game between the buyer and seller on that specific contract. One's gain is the other's loss.
And that difference, right, versus obligation really shapes how people use these things.
Absolutely.
Okay, we get the parts, we get the players. How do you actually use them? The source breaks down 4 basic moves, right? Like placing specific bets.
That's right. Think of these as the 4 fundamental starting points, like Table 3 shows. Buying a call, buying a put, selling a call, and selling a put. Each aligns with a different expectation about where the price is headed.
Let's start bullish. Buying a call. The source says beginners often start here, and I guess that limited risk is why.
Precisely. You buy a call if you're pretty confident the underlying price is going to go up, and probably up significantly, before that expiration date hits. You pay the premium for the right to buy at the strike price.
And you profit if.
You make money if the price climbs above your break-even point, which is simply the strike price, plus the premium you paid per share. Since stock prices can, in theory, go up indefinitely, your potential profit is unlimited.
And the worst case?
You just lose the premium you paid. If it doesn't work out, the option expires worthless. That defined risk is very appealing.
The Tesla example in the source really drives home the leverage aspect here.
It does. Buying a Tesla call, strike $180, premium $6.93 per share, so $693 total. If Tesla hits $200 by expiration,
You use your right to buy at $180?
right, then you could immediately sell at the market price of $200. Your profit, as the source calculates, is $286.93 times 100 shares, which is $1,307. You risk $693 to potentially make over $1,300 on just a $20 move in the stock. That's leverage in action.
Wow. Okay, that's the optimistic bet with capped risk. What if you think the market's going to tank? Buying a put.
Correct. You buy a put if you expect the underlying price to drop, again, probably significantly before expiration. You pay your premium, and this time you get the right to sell the asset at the strike price.
Profit comes if the price falls below.
Below your break-even point, which is the strike price minus the premium you paid.
Yeah.
Since the price can fall all the way to zero, your potential profit is substantial. And just like buying a call, your maximum loss is capped at the premium you paid.
The 10-cent example showed this, right?
Yeah. Buy a put with a HK $360 strike, pay HK $1.85 premium, HK $185 total. If the stock drops to HK $350,
You can use your right to sell at HK $360.
even though it's only worth HK $350, you could theoretically buy it at HK $350 in the market and immediately sell it using your option right at HK $360. The profit. HK $360, HK $3 and $2, HK $1.855 times 100 shares equals HK $815. Again, limited risk, but this time betting on a downturn.
Okay, buying calls or puts seems relatively straightforward in terms of risk, your max loss up front. But selling, that sounds like a different beat. Let's talk selling a call, especially a naked one where you don't own the stock.
It absolutely is riskier. When you sell a naked call, you're betting the stock price won't go up much. Maybe it stays flat, maybe it even drops a little. You collect the premium up front. That's your maximum possible profit.
But you take on the obligation.
The obligation to sell the stock at the strike price if the buyer exercises, and if you don't own the stock.
That's where the theoretically unlimited loss comes in.
Precisely. If you sold a call with a $100 strike and the stock unexpectedly rockets to, say, $300, the buyer happily exercises their right to buy from you at $100. You'd likely have to go into the market, buy shares at $300, just to immediately sell them to the buyer for $100.
Ouch. A $200 loss per share times 100 shares.
That's a $20,000 loss on one contract from collecting maybe just a few $100s in premium. The source's phrase, earn a candy, lose a factory, really captures that terrifying asymmetry. It's high risk, definitely needs margin collateral with your broker.
Earn a candy, lose a factory. Got it. Powerful warning. What about the flip side? Selling a put. Still risky.
Still risky, yes. But the loss isn't theoretically unlimited like a naked call. When you sell a naked put, you expect the price won't fall much. Maybe flat, maybe it goes up. You collect the premium, that's your max profit.
And the obligation is?
Your obligation is to buy the asset at the strike price. If the buyer exercises, which they'll likely do if the market price drops well below the strike.
So your loss potential kicks in if the price falls.
Right. If the price drops below the strike price minus the premium you received, you start losing money. Your maximum possible loss happens if the stock price goes all the way to zero. In that case, you still have to buy it at the strike price, so your loss is strike price 100 minus the premium you initially got. It can be very substantial.
You mentioned some people sell puts hoping to get the stock.
Yeah, some investors do this. If they like a stock but think it's a bit expensive, they might sell a put below the current price. If the stock stays up, they keep the premium. If it drops and gets assigned to them, they're forced to buy the stock at the strike price, but their effective purchase price is the strike minus the premium they collected. They see it as potentially buying the stock at a discount.
Interesting angle. So selling is really a different game, playing for income, but taking on much bigger potential hits.
And it changes how time and volatility affect you. Buyers are fighting against time decay theta, which eats their premium. They need things to happen fast.
Well, sellers.
Sellers benefit from time decay after they sell. Every day that passes makes the option they sold a little less valuable, which is good for them. They also often benefit if implied volatility drops. So sellers might have a higher probability of winning on any single trade if the option expires worthless, but they face that low probability, high impact, asymmetric risk.
Which is why brokers are stricter about letting people sell options, especially naked ones.
Definitely. They want to make sure you understand the risks and have the capital to cover potential losses.
Okay, that clarifies the basic mechanics and the four main plays. But after hearing all that, especially the risks, why would anyone bother? It sounds complicated.
It can be. But the source lays out some compelling reasons the advantages options offer.
Let's hear the good stuff then.
First big one, leverage. We touched on this. Using a relatively small amount of money at premium to control a much larger value of the underlying asset.
Like that $50 stock example, $5,000 to buy 100 shares outright versus maybe $500 for a call option controlling those same 100 shares.
Exactly.
Yeah.
And the source showed how a 20% stock gain, $1,000 on the $5,000 stock investment, so 20% return, could translate into a 200% return on the option, $1,000 profit on the $500 option investment. That potential for magnified returns is a huge draw for speculation.
Powerful, but yeah, sounds like it cuts both ways. What else?
Hedging. This is a really important one. Think of it like insurance for your investments. If you own a lot of stock and worry about a market drop.
You could buy put options.
Exactly. Buying puts can act as a hedge. If your stocks fall in value, the puts should increase in value, offsetting some or all of the losses on your shares. It's a key risk management tool.
Okay, leverage for potential gains, hedging for protection, any other benefits?
Income generation. We mentioned selling options. A popular strategy for people who own stocks is the covered call. You own 100 shares of XYZ. You sell a call option against those shares.
And you collect the premium.
You collect the premium. If the stock price stays below the call's strike price by expiration, the option expires worthless, and you just keep the premium as extra income. It's a way to potentially boost returns, especially if you think the stock will stay flat or only rise moderately. So, a way to make money from stocks you already own. Right. And finally, flexibility. Options let you craft strategies for almost any market view, not just, I think it's going up or I think it's going down. You can build positions to profit if the market stays totally flat, or if you expect a huge move but aren't sure which way strategies like straddles or strangles. They offer real versatility.
So leverage, hedging, income, flexibility, those are definitely powerful reasons. But the source adds a big but, right? These don't come free.
Not at all.
Yeah.
There are always trade-offs. Leverage amplifies losses too. Hedging costs money. You have to pay the premium for those protective puts. Selling options caps your upside, covered calls, or exposes you to big risk, naked options. And flexibility requires real expertise to use effectively. You need to be aware of both sides.
Which leads us perfectly into the flip side. The risks. We've touched on them, but let's really lay them out clearly. Every superpower has its kryptonite.
And you absolutely must understand these risks. The source is clear. For option buyers, the most direct risk is losing the entire premium. If your bet is wrong, wrong direction, wrong timing, not enough movement, the option can expire worthless. That's a 100% loss on that specific trade.
Just gone. Poof.
Yep. Then there's time decay. Theta. We measure this as the buyer's enemy. Options are wasting assets. As time passes, especially nearing expiration, their value erodes. Even if the underlying price is moving your way, just not fast enough or far enough, time is constantly working against the buyer.
Okay, time decay. What else?
Volatility risk.
Decay.
Option prices are sensitive to changes in expected future volatility, called implied volatility. If you buy an option and then the market suddenly becomes less uncertain, implied volatility drops, your option could lose value even if the stock price hasn't moved against you. You're bidding on future price movement and the level of market choppiness.
So you could be right on direction, but still lose if volatility collapses.
It can happen. The source lists other key risks, too. Leverage, again, it magnifies losses just as severely as gains. Small adverse moves can wipe out a large percentage of your option investment quickly.
And complexity.
Definitely. It's easy to get confused by the strategies, the Greeks, how everything interacts. It's not simple.
And we can't forget the seller's risk.
Right, that seller unlimited, huge loss risk on naked options. We hammered that point. But it's critical. That's why brokers are so careful. Also, early exercise risk for American-style options, which includes most individual stock options.
Meaning the buyer can exercise before expiration.
Anytime before expiration. So if you sold an option, you could be forced to buy or sell the underlying suddenly before you expected it.
That could mess up your plans.
It can. And finally, liquidity risk. Some options, especially those far from the current price or with distant expirations, just don't trade very often.
Meaning it's hard to buy or sell them.
Yeah, you might see a big gap between the buying price, ask, and selling price bid. It can be hard to get in or out of a position when you want or at a fair price.
So putting it all together for the buyer, you need the price to move significantly in the right direction before the clock runs out, while fighting time decay and hoping volatility moves favorably.
Yeah.
That sounds challenging.
It is. That's why many options expire worthless. And for the seller, maybe a higher probability of profit on any single trade by collecting premium, but always facing that potentially catastrophic asymmetric risk if the market makes a big, unexpected move against them.
And you mentioned that trap of cheap, out-of-the-money options for beginners.
Yeah, they look tempting because the premium is low, but they usually have a very low probability of actually becoming profitable. They decay incredibly fast, and most end up being a 100% loss for the buyer. Don't mistake cheap for good value.
Okay, wow. Potent tools, serious risks. If after hearing all that, someone is still thinking, okay, I want to explore this, where do they even start? How do you approach this responsibly? The source gives a pretty clear roadmap.
Yes, and following these steps is crucial. Step 1, non-negotiable. Build knowledge. You absolutely have to learn the basics first. Understand the terms we discussed, the core concepts, different strategies, and crucially the Greeks, delta, theta, vega, gamma.
The Greeks tell you how the option price reacts to things.
Exactly. How it changes with the underlying price, time, volatility, etc. You need to grasp that. Where to learn. Broker education centers, Fidelity, IDKR, Futu were mentioned, are often excellent. Finance websites like Investopedia, books, courses, info from the exchanges like HKEX. It's continuous learning.
So education first, then.
Step 2, choose a broker and get options trading permission. You can't just use any stock account. You need specific approval for options. Brokers will check your experience, finances, and understanding of risk before they let you trade, often peered by strategy complexity.
It's a gatekeeping mechanism for your own protection, really.
It is. Step 3, highly recommended. Paper trading, simulation. Practice with virtual money in a realistic market environment.
What do you learn there?
How to use the trading platform, how to place orders, how to test strategies risk-free, how prices actually move, how the Greeks impact things in real time. You start building discipline. Platforms like Matrade, XQ, Moomoo offer this.
But it's not quite the real thing.
No, the source rightly notes it doesn't replicate the emotional pressure of having real money on the line. Fear and greed don't really show up in paper trading, but it's essential practice for the mechanics.
Okay, learn, get approved, practice risk-free. What's next before trading real money?
Step 4, develop a trading plan and focus on risk management. even for beginners. What's your objective? What's your specific view on the market direction, timing, volatility? What strategy fits that view? Where will you enter? Where will you exit if it works? Take profit, or if it doesn't, stop loss.
And managing the money itself.
Absolutely critical. NGA capital management. Decide before you trade how much of your total trading capital you're willing to risk on any single trade. A common guideline mentioned is maybe 1% to 3%. This prevents one bad trade from wiping you out and helps control emotional decisions.
So it really is a marathon, not a sprint. Learn, practice, plan, then maybe start small with real money. Sounds like finding a broker with good education and simulation tools might be more vital for a beginner than just the cheapest fees.
For many beginners, yes. Those resources and the practice environment are incredibly valuable early on.
Now, the source also warns about common ways beginners mess up. Let's shine a light on those pitfalls so you, the listener, can try to avoid them.
Definitely helpful. Knowing what not to do is key. First, lack of preparation. Jumping in without really understanding the basics, the Greeks, the risks of the specific strategy. Avoid it by doing your homework and planning your trades.
We covered that. What else trips people up?
Ignoring risk management. This is huge. Using too much leverage, not setting or honoring stop losses, risking way too much capital in a single idea. Avoid this by having that capital management rule, like the 1-3% max loss per trade, and sticking to it religiously. Position sizing is crucial. Makes sense. Third, choosing the wrong contract. Picking strikes or expirations that don't actually match your market view or time frame. Especially beware those cheap, deep, out of the money or super short-term options. They're often cheap for a reason. Low probability, fast decay. Understand ITM, ATM, OTM implications.
Got it. Don't just pick the cheapest one.
Right. Fourth, underestimating time decay, theta, and volatility, vega. Forgetting theta is always eating away at buyer premiums, especially near expiration. Not understanding how vega means changes in implied volatility can whack your options price around. Be aware of time left and the voling environment.
This pitfall.
Emotional trading. Letting greed, fear, hope, or maybe the desire for revenge after a loss drive your decisions. Avoid this by sticking to your plan, using stop losses, only trading money you can afford to lose, and using that simulation time to practice discipline.
And finally,
Overtrading, or the get-rich-quick mindset. Options aren't lottery tickets. Success comes from skill, patience, and consistency. Not trying to hit home runs constantly or trading every wiggle. Avoid trading too often or too large. Focus on executing a solid strategy consistently.
and these mistakes probably feed off each other, right?
They often compound. Lack of prep leads to bad choices. Ignoring risk makes the bad choices hurt more, emotions take over, and it spirals. And remember that critical point. Don't just apply stock investing habits like buy and hold to options. The expiration date changes everything.
Right, time is finite here.
Fundamentally different dynamics.
Okay, well, we have certainly taken a deep dive today exploring the world of options using this beginner's guide as our map.
We really have. We've seen they're flexible tools, right? For speculation, hedging, income. Built on specific parts. The underlying call put type, strike, expiration, premium.
And they offer those clear advantages: leverage, protection, income potential, flexibility.
But, and it's always a big but, with options, they come with significant risks. Losing your premium, time decay working against you, volatility swings, the complexity, and that really serious risk for sellers.
And for anyone listening who's still intrigued, the path forward is clear. Educate yourself thoroughly, practice extensively with paper trading, start incredibly small with real money, and manage your risk obsessively.
And avoid those common beginner traps we just listed. It's a continuous learning curve. Success isn't guaranteed. It demands solid analysis, a clear strategy, disciplined execution, and keeping emotions in check.
It's definitely not easy money, but the source shows a clear path for those willing to put in the effort and respect the inherent risks. So as we wrap up, here's something to think about. Given the immense power of leverage, which can create incredible gains but also wipeouts, and the constant pressure of time decay, plus that stark difference in risk between buyers, limited loss, and sellers, potentially huge loss, where does the real allure of options lie for you? Is it more about their potential to protect your existing wealth through hedging? Or is it that tantalizing but very risky promise of exponential growth? What kind of balance makes sense for your own goals and your own comfort level with risk? Something to consider based on everything we've unpacked today.